70% of all your wealth will be wiped out by your second generation, and 90% will be wiped out by the third. And I already know that's a hard pill to swallow. So stick around for the rest of this video so your family doesn't end up becoming one of these statistics. Hello and welcome to the channel. Don't forget to like, share, and subscribe if you find any value at all from this video. So today we're going to be talking about generational wealth, and not just how to obtain it, but mainly how to keep it by leveraging your own family bank. So usually there's that one individual in the family that breaks all the barriers and completely changes that family's legacy. And the fact that you're here watching this video dramatically puts those odds in your favor. There are two main families that are usually brought up when anyone brings up the topic of family banking. And that's the Vanderbilt family and the Rockefeller family. And these happen to be two of the wealthiest families that ever existed in America. So Cornelius Vanderbilt made his fortune in the transportation business. At his death in 1877, it was estimated that his family fortune was worth over $100 million, which was more than the U.S. Treasury actually held at that time. If you were to translate that to today's times, his family would be worth about $200 billion, which easily placed him as the richest man in America. He ended up passing 95% of his wealth directly to his son, William Vanderbilt. And William started off doing great things with the money, but eventually the Vanderbilt family became known for their lavish spending. And there's nothing wrong with spending at all. The problem was they began spending more money than actual income they had coming in. And you don't need a degree in finance to know that's a recipe for disaster. And of course, they ended up losing it all. The Vanderbilts held a family reunion back in 1973, and of the 120 family members that attended, none of them were millionaires. So they literally went from the richest family in America to losing it all in just a few generations. And then you have the Rockefeller family. John D. Rockefeller made his fortune selling oil. He started Standard Oil of Ohio back in 1870. His business was refining more than 90% of the oil in the United States. And as a result, he then became the richest man in America. He ended up dying in 1937 and had amassed more than $1.5 billion. In today's dollars, that'd be worth over $340 billion. And his son, John D. Rockefeller Jr., inherited the vast majority of his wealth as well. So these two stories almost seem identical to each other. But here's the difference. John Jr. made a decision to keep all the family's money together. And little did he know that decision would completely change the legacy of his family. And he kept the money together by utilizing what's called a family bank. And this family bank is how the Rockefellers are still one of the wealthiest families in America. It's estimated they're worth about $8.4 billion. And that's while still donating $50 million a year to charity. And those two family examples are really important to understand because it gives you a chance to choose which direction you want your family legacy to head down. So now that we've talked about the why, now let's talk about the how. So here are the exact steps you need to know in order to create a family bank. The first thing you're going to do is create what's called a family office. And this will be a group of trusted advisors that will help your family maintain and grow their wealth. And this doesn't mean you have to go out and hire some expensive wealth advisor or something like that. Because again, the goal is to be as smart as possible with this money. So just figure out who's going to be the family's tax person, their investment person, their insurance person, their estate planner, their realtor, and any other area that may have a financial concern. And the overlap of those individuals helps make sure you always make the right financial decisions. Next, you want to put together a family constitution. This step is extremely important because this is where you set the guidelines for your family bank. And all future generations will have to follow those guidelines. And your family needs to understand that just because they are family does not mean they get guaranteed participation to this family bank. So you'll set up certain philosophies and values that must be maintained by the participants. You can include educational planning, which ensures that the younger generations learn about life, money, and wealth while they're still a child. One common principle that's used a lot is a family retreat, where the older generations teach the younger generations all these different principles. The Constitution will also dictate how money gets used. It could be for things like entrepreneurship, education, real estate, or other personal family situations. Then you want to create a family board. These are going to be various individuals that collectively decide whether someone can borrow money or not. And those decisions are based on a majority vote. But of course, you must maintain an odd number of board members to make sure there is somebody that can always be a tiebreaker. Then you move forward with establishing your trust. This trust will be your family bank. Now, the money that's going into the trust typically comes from a life insurance death benefit that paid out, the sale of a property, the sale of a business, a lump sum of money that's currently sitting in another account, or gradual funding during your lifetime. Traditional estate planning typically passes a lump sum of money to individuals with little or no conditions at all. But this entrusted planning focuses on giving your family the ability to replicate wealth versus just spend through the wealth. The goal is to make sure your family doesn't start over every generation at ground zero, but instead it will allow them to leverage your legacy to help them get an edge in life. And this method isn't about controlling everything from the grave, but rather give them the opportunity to tap into the family bank if they plan on doing the right things with the money. Next, you're going to have the trust purchase life insurance policies on all the participating family members for the highest amount possible. Now, it can't be any type of life insurance policy because the strategy won't work. It must be cash value life insurance. The first reason is because cash value life insurance allows your money to gain compound interest. And that's important because you always want to park your money somewhere that's going to be working for you versus having it sit somewhere getting little to no interest at all. These policies also allow you to take out policy loans on your own terms, which means you don't have to worry about credit worthiness or anything else that typically gets in the way of getting a traditional loan. And these loans usually have favorable interest rates. And some policies give you multiple options. And while there is an outstanding loan, you still gain compound interest on your entire cash value. However, the most important part of utilizing this specific type of life insurance policy is the fact that there is a permanent death benefit. And because you will have money constantly flowing in and out of your family bank, there's always a risk of someone not paying back their loan, whether it be for reasons within their control or out their control. So there is no guarantee that all the money the family bank loans out will be paid back regardless of the person's intent. But the one thing that is guaranteed is that no one lives forever. So when those insurance policies were set up, the trust was listed as a designated beneficiary. So that means upon someone's death, the trust will always be replenished back to what it was before it loaned out the money. But in most cases, it'll be a lot more because the death benefit is generally larger than whatever the loan was. And that death benefit pays to the trust 100% tax-free. And that right there ensures there will always be money available for the following generations to come. So mathematically, the trust will never be depleted. So now you have a clear understanding of what the Rockefeller family actually did versus what the Vanderbilt family failed to do. And now you can determine what you want to do for your family moving forward. Thank you guys for watching, and let me know in the comment section what you guys think about this strategy. And don't forget to hit the subscribe button for more financial content. And I'll see you guys in this video next.